Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Milestone Pharmaceuticals.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. We are dissecting Milestone Pharmaceuticals, and it's a company that really embodies that core tension in the biotech sector right now.
That high reward asset versus the high risk timing.
Exactly. They are standing right on the razor's edge, moving from being a clinical stage development company to a full-on commercial entity.
And that transition is where fortunes are, well, made or lost.
It really is.
So that framing is perfect. We have to start where they are today. We're looking at a company that has, what, zero revenue?
Zero revenue, which is totally typical for a biotech in this stage. Their entire future hinges on one specific approval. Exactly.
Right.
When we looked at their third quarter 2025 financials, we saw zero product revenue, just as we expected. But the key takeaway wasn't the zero.
Oh.
It was the expense discipline they showed while, building up for this big launch.
Tell us what that expense discipline looked like on the balance sheet.
Well, their non-GAAP EPS loss came in materially narrower than the market consensus.
Okay. And for our listeners, non-GAAP just means we're looking at core operations, right? Excluding some one-off accounting things.
Precisely. The fact that their loss was lower than predicted, it signals they're controlling their day-to-day burn rate much better than the street anticipated.
Even while spending to prep for a launch.
Even while spending heavily. And that's a massive positive signal about management's efficiency.
That signals good stewardship of capital, which matters a ton when you're pre-revenue. But looking forward, this stage creates something you often call an asymmetric opportunity. Can you break that down for us? Why is this setup so powerful if they get approval?
For sure. This is the blue sky scenario. And it's why people invest in these late-stage biotechs. Milestone has already shouldered the vast majority of the fixed costs.
You mean the expensive clinical trials, the R&D?
All of it. The R&D, the SG&A for building out the launch infrastructure, those are essentially sunk costs at this point.
So the profit mechanism is already primed.
Precisely. Once they get volume scaling, every single incremental unit sale of their primary asset, CARDAMYST, is just going to drop onto a largely fixed operational base.
Creating what you call powerful operating leverage.
That's it. Once those sales volumes hit scale, maybe post-2026, the profitability curve won't be a gentle slope. It'll be steep. It'll accelerate rapidly because the heavy lifting on overhead is already done.
That powerful leverage depends on a successful launch, though. And launches are cash hungry. What does their liquidity look like to cover that burn?
They are, well insulated for now.
Yeah.
They reported $82.6 million in cash and equivalents as of Q3 2025.
Which is a pretty solid cushion.
It is. And management has stated, with a lot of confidence, that this cash position is sufficient to fund everything through the regulatory process and into that initial commercialization phase.
Okay, that's a strong baseline. But the real crucial financial catalyst, the one that really de-risks the launch, is tied directly to the FDA outcome, isn't it?
Absolutely. This is where the strategic financing comes in. They secured a contractual $75 million royalty payment.
And that money only hits the bank if the drug is approved.
Only if it's approved. So if you combine that $82.6 million cash on hand with the $75 million payment they expect, their pro forma liquidity jumps to over $150 million.
That is a huge war chest.
It is, and it mitigates that near-term dilution risk substantially because they won't need to rush back to the equity markets for more cash.
So a large cushion of cash plus anticipated non-dilutive funds. That's the bull side. But we should also mention their use of debt. Their short-term solvency is strong, but they have used a lot of debt to finance this build-out.
They have. Their debt-to-equity ratio is high. But they've used this structured financing, like these royalty deals, precisely because they wanted to avoid selling off equity.
And diluting existing shareholders.
Right, at what might have been an unfavorable price earlier in development. It's a calculated strategic use of leverage to get them through this critical phase.
Let me just challenge that for a second. Strategic debt sounds great, but if the FDA timeline slips, say, another 6 months, doesn't that high debt ratio immediately put them at greater risk?
That is the core risk of their financial structure. It really is. If the delay is prolonged, say, past mid-2027, the burn rate could force their hand.
Into a punitive equity raise under worse conditions.
It could. However, that cushion, that potential $150 million, it gives them flexibility that most biotechs in this spot just don't have. They have time to address the manufacturing issues without needing to panic finance.
Okay, that makes sense. We've established they have the capital and the setup, but none of this matters unless the product is a winner. Let's pivot to the core asset, CARDAMYST.
Right, the driver here is etripamil, which is branded as CARDAMYST. It's targeting a condition called paroxysmal supraventricular tachycardia,
Or PSVT.
PSVT for short, yeah. It's a recurrent, rapid cardiac arrhythmia. And to give you some context, if you have a serious episode today, the standard of care is a trip to the ER,
A panic trip.
a panic trip to the emergency room for intervention, usually IV adenosine or calcium channel blockers.
Which sounds terrifying and extremely expensive, and this is where the innovation comes in. What makes CARDAMYST so different?
The change is, well, it's revolutionary, both clinically and economically. CARDAMYST is a self-administered nasal calcium channel blocker,
A nasal spray.
a nasal spray.
Yeah.
The innovation is that it enables on-demand treatment right when the episode starts. It allows for at-home conversion.
So you're replacing a high-cost, stressful e-visit with something you can do in your own living room.
Exactly. It's a massive quality of life improvement for the patient.
And for the payers, the insurance companies, what's the benefit for them?
The economic benefit is tremendous. ER visits are a huge cost center. By proving patients can safely and effectively stop these episodes at home, Milestone is drastically reducing healthcare utilization.
Which gives payers a strong financial incentive to push for CARDAMYST.
A very strong incentive.
And the clinical data isn't just theory, it's robust. What does the data show on efficacy?
It's highly consistent. The data shows strong efficacy with a median time to conversion, so the time until the heart returns to normal rhythm, of about 18.5 minutes.
Wow, that combination of speed and convenience is what gives it that competitive edge.
It really is. But in biotech, that edge relies heavily on intellectual property.
So what's the patent situation? What's the commercial runway look like?
This is a huge point of strength. They recently secured a critical patent extension for etripamil, which now protects the IP all the way out until 2042.
2042. Wait, really? In the biotech world, having nearly 2 decades of exclusivity that's almost unheard of.
It's a major, major competitive advantage. It creates a huge barrier to entry for anyone else.
And they're not just stopping there, are they? They're treating this as a platform.
They are, wisely. The successful FDA progress for PSVT de-risks a second and potentially much larger indication: atrial fibrillation with rapid ventricular rate, AFib RVR.
And they're already prepping a phase 3 for that.
They are. So a win in PSVT basically validates the whole mechanism and delivery method for a much broader class of cardiac issues.
Beyond the patents, you also mentioned a behavioral moat. What does that mean? How hard would it be for another drug to displace this one later on?
It would be extremely difficult. In this field, confidence is everything. Electrophysiologists and patients need to gain absolute trust in the self-administration workflow.
So once CARDAMYST becomes the standard,
Once it's the de facto treatment, switching to a competitor would mean high clinical risk, retraining doctors, re-educating patients. That first mover advantage creates a powerful lock-in effect.
okay, shifting gears, let's look at how the market is viewing this. What's the technical chart telling us?
The chart shows a pretty constructive event-driven pattern. It suggests investors have been, accumulating shares ahead of this big regulatory catalyst.
We've definitely seen evidence of that. The stock found strong support near its 200-day moving average, which is a key long-term indicator.
Right. Buyers consistently stepped in around that $1.70 to $1.80 area. That's typically a sign of smart money accumulation.
The big players see that as the floor. And on the upside, resistance is near the 52-week high, right? Around $3.
Yeah, in that low $3 range, $3 to $3.10. A positive regulatory resolution could trigger a high-velocity move right through that ceiling.
What about momentum? Is the stock already overbought, or is there still room to run?
We look at the RSI, the Relative Strength Index, and it's sitting around the low 50s.
Which is pretty neutral.
Neutral to constructive, yeah. It confirms the stock isn't overheated yet. This looks like early accumulation, not a final spike.
So it sounds like the setup is almost textbook for a potential biotech surge.
It absolutely is. It's a classic volatility squeeze scenario. You've got defined risk levels, a clear binary catalyst, the FDA meeting, and plenty of room for a powerful move up.
And sentiment seems cautiously bullish, even with the regulatory hiccup. What about leadership? Are they showing confidence?
Management confidence seems visibly high. We've seen recent stock option grants for new hires, often at market prices. That's a classic way to align incentives.
If the stock goes up, they benefit directly.
Exactly. It's a very positive sign of insider belief.
Okay, we've covered the financing, the product, the technicals. Now we have to unpack the biggest uncertainty: the regulatory risk. What's the bear case right now?
The main overhang is the complete response letter, the CRL, they received earlier in 2025.
Which is the FDA's way of saying they can't approve the application as is. That caused a big sell-off.
It did. But the distinction here is critical. We have to know why they got the CRL.
And it wasn't about the drug itself.
That's the whole point. This is why the risk is technical, not existential. The CRL cited only chemistry, manufacturing, and controls deficiencies, CMC issues.
So it's about how the drug is made, the quality control, not whether it works or is safe.
Precisely. The FDA raised absolutely no safety or efficacy concerns about the drug or the data. The data is solid. This is, at its heart, a solvable engineering and quality problem.
So the market seems to have already discounted that risk after the drawdown.
That's the consensus, yeah. The entire investment thesis now boils down to the timeline for fixing it. And the dominant catalyst to watch is the company's request for a Type A meeting with the FDA.
And what's the significance of a Type A meeting?
It's a high-priority meeting between the company and the FDA after a major setback like a CRL. The outcome will clarify the exact remediation path and, most importantly, set a concrete resubmission timeline.
That date is everything.
It's everything. It dictates the new approval timing and when the revenue ramp can finally start. Watching for news from that meeting is the single most important thing for an investor right now.
But we should reiterate the warning. Even with strong liquidity, prolonged delays could still force their hand on financing, right? No buffer is infinite.
That's true, but their financial flexibility gives them the best possible setup to address these issues without accepting punitive terms. The focus is just execution now.
Fix the technical problems and get that new date.
To summarize, Milestone presents a really high-conviction, asymmetric upside opportunity. It's anchored by CARDAMYST, a true first-in-class asset.
With robust data and that incredible patent protection out to 2042.
Right. The main risk is purely timing due to those CMC issues, which look manageable given their strong balance sheet.
So this is really a setup for a massive re-rating, moving from a clinical stage valuation to a commercial one. While traders might play the immediate news, the full value, especially with the AFib potential, is probably a multi-year hold.
Looking out 12 to 36-month post-resolution, for sure. And here's a provocative thought for you to consider as we wrap up. Given the product's novel positioning, that strong behavioral moat, and that long patent protection, this asset profile makes Milestone a highly strategic target.
A takeover target.
A potential takeover target, yeah. Larger cardiovascular players are desperate for self-administration platforms like this. It could make the whole company an irresistible piece of IP down the line, even if there are no rumors today.
A compelling final thought. If you want to stay updated on Milestone's progress, make sure you subscribe, like, and comment underneath to support our podcast. And don't forget to let us know which stock you want us to look into next.